Welcome everyone on this webinar that we have for mastering Japanese candlesticks trading. So myself Amar Singh, and I will be talking about Japanese candlestick patterns. And the structure of the webinar is such that first of all I will be introducing Japanese candlesticks, some historical background, then candle patterns simplified, which are the candle patterns which you should actually look at. Then I'll give some case studies, also take some examples and see how that works out. And then lastly, combining candlestick patterns and Western indicators. How candlestick patterns alone can give you excellent results, but if you combine them with Western indicators, the results will be even better. So, starting with introduction to Japanese candlesticks. There's a very nice saying that candles exhaust themselves to give light to men. So Japanese candlestick charting and analysis is one of the most effective technical methodologies in the universe of technical analysis. So Japanese candlesticks has stood the test of time. When I talk about the historical background, you'll come to understand how it has been working. And for past 2 decades, most investors have been aware of and traders have been aware of candlesticks. Most common statement is they know about candlesticks, they just don't know how they work. So I will be resolving this issue, and you will, by the end of this webinar, you'll be able to understand how the Japanese candlesticks works, what's the psychology behind them, which are the most popular candlestick patterns, and also how you can meld them with Western indicators for excellent results. So an extremely high percentage of chart followers have the candlestick formation on the charts versus the standard bar charts. This is due to the favorable visual impact. The illustrative properties of the candlestick chart makes viewing much easier. What was happening was that earlier, a couple of decades back, it was primarily bar charts which were most popular. But once Japanese candlesticks came to be known in the global arena of trading, and that was bought by a person named Steve Neeson of the United States. So he was the one who actually, when he was working in Japan, he found that the Japanese were looking at charts and they were looking at candles and all that. So since that was in Japanese, he was not able to understand. But he somehow had the patience and the conviction to understand them, go and get them translated into English, and then he wrote a couple of books on Japanese candlesticks. And then that was how Japanese candlesticks came to be known in the world. It was in somewhere in mid 80s or so. So since then, Japanese candlesticks have picked up very fast, but over the last 15-20 years, it has become very popular. So Japanese candlestick analysis is a highly effective but underused investment decision making technique. Candlestick charts reveal many insights using well recognized Japanese candlestick formations, yet few people understand the ramifications or significance of the signals that are clearly and reliably displayed. I will show you in the charts how some, even if you understand or you learn about 8 to 10 different popular and most important candlestick patterns, how that can help improve your trading significantly. Or even if you're an investor, then also it can be a very good idea if you can look at the Japanese candlestick patterns on monthly charts, on weekly charts. More importantly, learning the principles of market psychology underlying the candlestick methodology will revolutionize your overall technique psyche forever, as fortunes have been made using the Japanese candlestick techniques. It's a very effective technique. You can use it on a 5 minute chart, a chart, 15-minute, hourly chart, a daily chart, a weekly chart, a monthly chart, whatever. So the best part is it works across time frames, but you have to meld it with other indicators. More than 400 years of refined reversal identification and trend continuity projection is there for understanding. Mastering the candlestick methodology will be the next major step for maximizing investment returns. So the benefits from the Japanese candlestick system is that the Japanese candlestick signals possess one major attribute that is not present in other technical systems. The signals are created by a change in investor sentiment. So the best part is, if you understand Japanese candlesticks, you will be able to understand investor sentiment like no one else, and you yourself will find that your interpretation analysis of the markets has improved significantly. I would say not by a 20% or 30%. It could be multiples of your experience, and your skill will improve. So this point is the crux of the success of candlestick analysis. The signals are created by a change in investor sentiment. The graphical formation of a signal makes reversals immediately visible. A candlestick formation provides a visual graphic of investor psychology during a specified time period. And investment strategies can be suited, of course, for whatever time period is suited for trading, minute to minute or monthly. I would say in most of in the liquid counters like Nifty or Bank Nifty, even a minute chart, if you see, just to give you an example, if there are some very strong candlestick patterns are there, and you act on them, then they can really help you. Also, what you need to understand is that if you use support and resistance levels which are there in the pivot support and resistance along with the Japanese candlestick patterns, they can really work wonders for you. And also, if you want to excel further, then adding some Western indicators will do even better. So I'll be talking about that in the end. So candlestick signals incorporated with other types of charts fine-tune the reversal identification process. So now we look at the historical perspective of candlestick patterns. There is a saying that success is a ladder that cannot be climbed with hands in your pockets. So if you want to become successful, if you really want to be a success in the markets, then you have to put in the effort. So, knowing the history of the formations inevitably imparts confidence in the Japanese candlestick technique. Many of you might have heard of Japanese candlestick technique, but how it has evolved or how long it has been there. If you understand that, then your confidence in this application of candlesticks will improve significantly. So, there were Japanese rice traders who developed a system over a 400-year period, and logic dictates that a system that has persevered that long must have credible features. So the point here is that if there is a system which has been in place for 400 years, that means there must be some value in the system. Otherwise, if the system did not have value, then it would not have survived so many centuries. And the history of the rice traders that developed the signals reinforces that assumption. So, with its 400 years of development, the Japanese candlestick methodology got its final major refinement in the mid 1700s. So, there was this person by the name of Kosaku Kate in 1716. He was born in 1716 and died in 1803. He was born in the city of Sakata during the Tokugawa period. We don't need to get into that, but just for your understanding. Adopted by the Honma family, he became known as Sokuta Honma. His successful interpretation of the candlestick formations made him the most feared and respected rice trader in Japan, and the wealth he produced for his family became legendary. So, the key takeaway from this is that this gentleman by the name of Kosaku Kate, born in 1716, died in 1803, he was adopted by a family, Honma family, and he became known as Sokuta Honma, and he successfully interpreted these candlestick formations, which made him the most feared and the most respected rice trader in Japan. And the wealth he produced for his family became legendary using Japanese candlestick techniques. So I think you would have some idea now. So, although Honma did not originate candlestick analysis, his rules and philosophies gave the technique credibility. In his early 50s, Honma wrote 160 rules that became the cornerstone of the Japanese candlestick analysis, as well as the basis for Japanese investment disciplines. His use of the three period patterns is the foundation of Japanese charting, along with other Western charting practices. So, through candlestick recognition, the name Shokyu Honma is associated with successful investing in Japan, as the name Bill Gates is associated with successful computer program marketing in the United States. Learning to consult the markets, as Honma did a few hundred years ago, will greatly enhance your investing or trading probabilities in the market today. So what I mean to say is that you have to believe in the candlestick patterns, And the reason to believe is that it has survived over 400 years. The people who've used them, they become very successful. Japanese are considered the most successful traders on this planet. So there is no reason for you not to become serious while using candlestick patterns. So now we look at consult the market about the market. So when analyzing the market, you have to pay attention to the market movement itself. In other words, you consult the market about the market. So you don't need to go anywhere else. If you look at the charts, if you look at the candlestick patterns, they themselves will tell you a very good story. Theoretically, it is not possible to predict the market's future. Yet analyzing identifiable patterns as a prelude to a high probability result is as close as an investor can get. So what the point here is that you can't be 100% certain that a trade is going to go this way or that way, but the probability can increase significantly in your favor if you use the Japanese candlesticks. And repeating patterns are not 100% accurate, but visually verifiable probabilities can adjust the odds immensely in your favor. And identification of certain events provides a basis for predicting an occurrence. So if now we will look at some examples, so we'll come to that. So what exactly are the candlesticks, how they are formed? Now I'll talk about that. So candlesticks, the word candlestick should ring a bell. It is basically a candle. If you see a candle, you have a candle which has a wick on its top which you burn, and the candle gives you light. But in Japanese candlesticks, apart from the upper wick, you have a lower wick also. So if you look at this figure on the left, you will find that first there is a bar chart. So if you look at a bar chart, what happens is that the left horizontal, this one, if you look at this, this is the open of the day, this is the high of the day, this is the close of the day, and this is the low of the day, and this right one is the close of the day. But if you look at a candlestick pattern, so this is more of a candle, but here you see that there is this upper wick and there is this lower wick. Now you find that and this bar chart has been compared with a candlestick pattern. That a bar chart, if a bar chart will look like this, then the same data for a candlestick will look like this. So these horizontal lines which are there, this they represent the open and the close. And once both lines are added to the chart, they are boxed. So this is the body of the candlestick. This is the body of the candlestick, and these are called the shadows of the candlestick. Upper shadow and lower shadow. So if the close, you need to remember that if the close is open, if the close is higher than the open, this, if you look at it, this is the close. If the close is higher than the open, the body is either white or empty, or it can be green. Likewise, if the close, this is the close, is lower than the open is here, and you can see from this that the open is here and the close is here. So if the close is lower than the open, then the body is black or filled, or it can be red. And this is the upper shadow and the lower shadow. So the upper shadow, you will have the high of the day or whatever period you're using. If it's an hourly chart, so high of the hour, and the lower shadow will be the at this tip will be the low of the day. So keep in mind that this does not necessarily mean that a white body represents that prices was up for the day, or that black body represents that price was down for the day. The body color only illustrates where the close was compared to the open. The contrasting colors of the body provide for rapid visual interpretation. So the point here is that, say for example, the stock has opened here and it has closed here, does not mean that the stock is only trading in this range. It came down, it hit a low, and then again it made a high, and then it closed here. But what you need to remember, that if the Japanese candlestick is closing higher, then either it will be a white candle or it will be a green candle, or and likewise if the close is lower than the open, then it will be a black candle. It could be a the body will be darkened, the body will be filled, or it will be a red candle. So I hope I am clear so far. So now we look at the Japanese candlestick charting. This dramatically increases the depth of information conveyed for visual analysis. So some have Japanese names, some have English names. Single candles are often referred to as yin and yang lines. These are something which you can just listen to. this wouldn't be much of material importance while trading. So these terms are actually Chinese but are used by Western analysts to account for opposites. Yin and yang. Yin is bearish, yang is bullish, just like in and out, up and down, over and under. And yin and yo are the Japanese equivalents. So yin and yang. Yin means bearish and yang means bullish. So what this effectively means is that this is a yin candle, bullish. Yin is a bearish. So this is a yin candle and this is a yang candle. Now we look at candle patterns simplified and some case studies. These are the key patterns which I have put across. There are close to almost 80 plus patterns, but if you can know what I am covering in this webinar, and if you delve deep into it and understand them even better, I can guarantee you that the quality of your trading will improve significantly. There is no second thought or doubt about it. So now we will look at some of the candle patterns. We have something called the black Marubozu. So what does a black means? Black Marubozu means that it is the day has closed lower than the open. So in this chart you can see it is a red candle. As I talked that it could be black, it could be filled, or it could be red. You can have any color, but we just chosen red means selling and green means a positivity. That's the reason I have taken this. So in Japanese, Marubozu basically means closed, cropped, or close cut. So black Marubozu means bald or shaven head is more commonly used in candlestick analysis. Its meaning reflects the fact that there are no shadows extending from either side of the body. So the long black body has no shadows at either end is known as the black Marubozu. It is considered a weak indicator. It is often identified in a bearish continuation or bullish reversal pattern, especially if it is occurring during a downtrend. So a long black candle would represent the final sell-off, making it an alert to a bullish reversal setting. So a black Marubozu, if you look at this pattern here, this one, this is what a black Marubozu, but it is colored red, so you have to look at it. It's not called red, it's called a black only, black Marubozu. So what it effectively means is that after a rally, this candle is formed. So this candle basically doesn't have an upper shadow, has a very small lower shadow, and it moves in the opposite direction. So it means that this is becomes a very strong level of resistance or a top, and you see that the markets have corrected from there. So this is something which is there. So if you find that on any time frame, on any chart, on any stock, a black Marubozu is formed, a red candle is formed, you have to really see how it is there, how it is formed, and where it has formed. If it is formed at the top, that means that the likely a top has been formed. If it is forming close to the bottom, then the markets have corrected, then you'll have to wait for the next few candles because they will give you a clue as to what is likely to happen next. So just as we have the black Marubozu, similarly we have the white Marubozu. So a white Marubozu is a long white body with no shadow. So you can see that a Marubozu is a candle wherein you don't have an upper shadow or a lower shadow. And here, if you look, see this. This is a white Marubozu. That's it's colored green though. Again, this is not exactly of that, but you can see that this formation has more or less what it means. It has made a bottom, and then it has the stock has rallied. This is the stock has rallied all the way. This is Vedanta at a point of time. So I just took some stocks and I put that. So you can look at it that this was a white Marubozu. So it is an opposite of the black Marubozu. So generally in Japanese candlestick patterns, what you will find is that you will always find opposite. If one pattern is bearish, you will find an equivalent pattern which is bullish, and vice versa. Next, there is something which is again important is a spinning top. Spinning tops, you must have all known that a spinning top is in this case, this is the candle which is a spinning top. Meaning what? That spinning tops are depicted with small bodies relative to the shadow. So if you look at the body of this red body, it is comparatively very small as compared to the shadow of this candle, upper shadow. So what this means is this demonstrates some indecision on the parts of the bulls and the bears. So they are considered neutral when trading in a sideways market. So here what we are seeing is that the stock has rallied all the way from here, and here we have a spinning top. This is a doji formation. I'll be talking about that as well. This is an evening star formation. Now this becomes a perfect selling point. So had you sold here from almost 330 levels, the stock corrected to almost 300 levels, a 10% correction. So if there are a combination of candlestick patterns which are being formed on the chart, then the probability increases significantly. So as I said, this is a spinning top. So a spinning top basically now, and there is a logic behind it. I'll explain the logic also. If you look at this, the body is very small as compared to the shadows. Again, the body is very small as compared to the shadows. What it means is, we take this white one. So white, what it means is that the close is higher than the open, and then what happened is that the stock moved lower, came back again, it moved higher but came back and closed in a very small range. So what it means is that the buyers and the sellers, that is the bulls and the bears, they were unable to do anything in the market. So it was more of indecisiveness, or what it means is that the bulls and the bears are equally poised, they are equal in strength. So it means is that if after a major rally you find spinning tops being formed, that means you should become cautious. That maybe now the bulls are not very strong, the bears are becoming strong, so there could be some sell-off which is happening. But you should wait for other confirmations as well. So it is the size. It is not the size of the shadow is as important as the size of the body. So for spinning tops, you have to look at the size of the body. So I hope I'm clear so far. Now I'll talk about another pattern which is something again very important and very useful is a doji. This is one of the most important signals in candlestick analysis. A doji, you can see that this is the body of the doji. So the body is nothing but a horizontal line. So what it means is that the open and close, because an open and close, if you look at this previous example, the open and close that forms a body. But in a doji, what happens is that the open and close are the same. So it means that the bulls and bears during the whole day or during the period that you're looking at, a weekly chart or a daily or hourly chart, there was movement, extreme movement on the upper side and the lower side, but neither the bulls were able to take the stock higher, neither the bears were able to take the stock lower. And what happened in the end was that the bulls and the bears somehow managed to just close where it all started. So this is one of the most important signals in candlestick analysis. It is formed when the open and the close are the same or nearly the same. So the lengths of the shadow can vary. The longer the shadows are, the more significant the doji becomes. So now also always pay attention to the doji. So now if you look at this particular chart, what you are seeing is this is a monthly chart. Earlier, I was showing you this previous example which we are seeing, that was a more or less a daily chart. Now this is a monthly chart, and you see that on a monthly chart there is a doji formation. And again, this is another pattern which is called the shooting star formation. And if you look at these two, the highs of these two candles on the monthly charts are more or less the same, somewhere around 320 or so. Again, this is Vedanta on a monthly chart. The highs are the same. This is called a tweezer stock. So what you are having here is a three candle formation. One is a doji, one is a shooting star, and the other is a tweezer stock. So it effectively means that were you long, you should definitely book profits if something of this happens on the monthly chart. And see what has happened from there. All the way 310 down, the stock was down to 90 earlier, later it went to 60 as well. So the point what I'm trying to say is that, and the best part is that they work across time frames. If you are finding a doji on an hourly chart, then also it will work. But what you need to understand is generally, uh, if a candle pattern is being formed, ideally you should get the results in the next 12 to 10 to 15 candles itself. So you'll find that the results, if it's a bullish candle pattern, then the results that the stock should move up in the next 10 to 12 or 15 candles max. Or likewise, if there is a bearish candle formation, but again, bearish candle formation, where it has to form, that also is very important. It has to form at a top. Say, for example, this is a top which is there. If a bearish candle formation is forming somewhere here, then you have to be take it with a pinch of salt. So I hope I'm clear here so far. Then one variation of the doji is a gravestone doji. It is why it is called a gravestone. You see the grave there is a stone, and then again you have the stone here. wherein the name of the person deceased and his age and when he was born and all that is said. So it represents a grave. And if this gravestone doji is formed at a top, that is on a, it can be on an hourly, it can be on a daily, weekly, monthly, then you have to become extremely cautious. So a gravestone doji at the top of the trend is a specific version of a shooting star. So we'll talk about that as well. So a gravestone doji is formed by the open, close, and the low being the same. So the Japanese analogy is that it represents those who have died in the battle. So the victories of the day are all lost by the end of the day. So see the psychology behind it. What happened was the stock opened here. That was the low of the day. Then the stock made a high, but the bulls were not able to hold this, and the bears started selling. And the after the entire period, the stock comes and settles at the open of the day. So the bears are not strong. The bulls have the bulls are not strong. The bears have somehow managed to bring it back here. So if after a major rally you find a Gravestone Doji, you can be rest assured that that is a time to book profits. And if you see some other indicators also pointing that there could be some selling, you could go short with a stop loss above the Gravestone Doji. Next, we come to another important indicator, that is the bullish engulfing pattern. This again is a very high probability trade. You should definitely look at this. So never go short if a bullish candle pattern is being formed. So I'll be talking about that as well. So, so the engulfing pattern is a major reversal pattern. It is a reversal pattern composed of two opposite colors. So here you see one candle is a red, the other is a green. If you look, here is a black, the other is a white. So the bullish engulfing pattern is formed after a downtrend. So after a correction, if there is a bullish engulfing pattern, then that could be a top which is a bottom which has been formed, and the stock could maybe rally from there. So what it does is that it opens, see this. This was a day. So the stock opened here, closed lower. So we have a black day. The next day, what happens is that the stock opens lower. So it opened lower than the previous day's close. So the previous day's close was here. It opened lower and then closed. Look at the close. The close was above the previous day's open. You can see this, that in this the open was here, the close was here, but the next day what has happened, the stock has opened lower, but it has managed to close higher above the open of the previous day. So this body has to engulf, that is cover the entire previous day's body, then only it is called an engulfing pattern. And if it is a green candle or a white candle engulfing the red candle or a black candle, this becomes a bullish engulfing pattern, and this is formed during downtrends. So here you can see that this is bullish engulfing pattern has formed, and you can also see that once this candle is formed, then this green candle is formed. So this becomes a short-term bottom, and the stock moved up, then again came down, moved up, again came down, then rallied, but it did not breach this low. So the low of a bullish engulfing pattern becomes a very strong bottom. So I think you should definitely look at these some of these patterns. So engulfing can include either the open or the close being equal to the open or close of the previous day, but not both. So just what you need to understand is that if it closes above it opens generally lower again than the previous day's close and closes higher than the previous day's open, and that is a bullish engulfing pattern. If it engulfs the shadows also, nothing like it. But then that is not a required of a bullish engulfing pattern. It is basically the body. That is, this body should engulf this body. Here, what we are seeing is this body more or less engulfs the shadows also, so it becomes even more powerful. Likewise, we have a bearish engulfing pattern. So a bullish engulfing pattern, if it is forming after a downtrend, the stock is corrected and you find a bullish engulfing pattern which is formed, and if you can see that whether that is a support zone, and you see that yes, that is a support zone, then that becomes an ideal buying point. You can trade, you can buy putting a stop loss below the low of the bullish engulfing pattern. Likewise, if you look at this bearish engulfing pattern, so bearish engulfing pattern is just the opposite of a bullish engulfing pattern. Here, after a uptrend, you have a black candle or a red candle covering the previous day's either white candle or the green candle. So in this case, what is happening is that there is an uptrend in this day. The day starts here, opens here, and closes here. The next day, the market opens higher but closes lower than the previous day's open. So it you can see that this red candle is engulfing this entire green candle, even one shadow of this. The lower shadow is also being engulfed. Now see what happened. This was a top which was there 380 or so, and from there the stock corrected all the way. That was the top that is made, and it is even more significant if it is being formed on weekly charts or monthly charts. Even on daily charts, it's very good. Hourly charts, 15-minute charts also, but 15 minutes ideally you should use only in most liquid stocks. If you are extremely short-term trader, then you can use. But there again, I would suggest that you should have pivot support and resistance levels that will increase and enhance your probability of being right. So a bearish engulfing pattern is a major reversal pattern again composed of two opposite colored bodies. The bearish engulfing pattern is formed after an uptrend, and as I've explained, it opens higher than the previous day's close and closes lower than the previous day's open. So the red candle engulfs the previous day's green candle. Next, we look at another pattern which is called a hammer. So hammer is something which you can easily picturize. It's a photograph of a hammer. So if you look at this, it's called a takuri and it's a bullish pattern. So if after a major correction you find a hammer which is being formed. Now this is a chart of Nifty weekly chart. So on a weekly chart, you can see here it is written mentioned weekly. So if you can see weekly, it's a weekly chart and this is a perfect hammer. What has happened here is that the stock opened here, that is Nifty opened here for the week. That is on Monday it opened here, and then for the week it went down all the way down here. So the bears were able to sell and bring it down, but somehow the bulls were able to manage to bring it back in the end of the week and managed to close in the green. So this is a hammer because, and what is a hammer? Hammer is, you can picturize a hammer. Here the basic criteria is that the shadow must be at least two times the length of the size of the body. So you can see the body. The body is so small here. That is the width of the body. And you look at the shadow. The shadow is more than two times this. So the longer the shadow, the better off. So this becomes a takuri. In Japanese, it's called a takuri. Here, takuri means the shadow is three times or more than three times the size of the body. Now look what has happened here. This hammer was formed. Nifty formed a bottom, more or less. It made a similar bottom later on a weekly chart, and there it was a rally. So had this formation been there, you understood this. So at least you wouldn't go short here, or if you were in your long positions, you wouldn't exit your longs because this is a time where you actually should hold. And just see this pattern. This is just the opposite of a hammer. This is called a shooting star. Again, this is a top formation. We have a star here, we have a doji here, we have a shooting star. So this becomes a top. So I'll be talking about shooting star later. So I hope this is also clear to all of you. This is generally a hammer is found at the bottom of a downtrend. So there has been a downtrend, a hammer is formed, and this shows evidence that the bulls have started to step in. So a positive day is required the following day to confirm the signal. So if a hammer is formed, you have to wait for the next candle formation, because generally what happens is that in a downtrend, the candle this low could be brief, so you'll have to wait for the next candle. So what has happened in the next candle? It was a shooting star, but this is not a valid shooting star because the shooting star has to form at the top. But what it shows is that the bulls and the bears again are indecisive. Then again we had an up strong move, 2 days down, then a strong move. So more or less the low of the hammer was maintained. So I think you should definitely look at this. Then just as we have the one that is formed at the bottom is called a hammer. When it is formed at a top, if you look at this pattern, this is a hanging man. So after a rally in an uptrend, you have it is again a hammer, but a hammer is something which is, as I said, is formed in a downtrend. So again, you could have a black hammer, you could have a red hammer, but and you could have a green hammer. So a red hammer or a green, but this is a green hammer, so it becomes even more powerful. So, so looking at this hanging man formation, what we are seeing here is that the market has moved in an uptrend, and then there is this This again is a hammer formation, but it is at the top. So this is called a hanging man formation. So what is the logic of this? That we just take this example that the stock opened here, went down all the way, came up and managed to close above the open. So it has closed above the open. So this is a green, you can say green body. Here this is a red body. So the red body is even more significant than a green body, but that really does not that much importance, as is the size of the shadow vis-a-vis the size of the body. So this is a hanging man formation again. This is on a daily chart. See what has happened. Hanging man, you can understand that the man who is hanging, so from the top. So that's an ominous sign. That's a bearish signal. So see what has happened after that. Nifty started correcting all the way down. It was on a daily chart and Nifty correct. So if a hanging man is formed after a major rally, you should become cautious. You can just think that that's a red light or a green or a yellow light. It's no more a green light. So you can become very cautious. See, that is the major advantage of Japanese candlesticks. It's early warning signal. In no other indicator gives you as early warning a signal as the Japanese candlestick technique. Period. It is found at the top of an uptrend. So the Japanese name this pattern because it looks like a head with feet dangling down. So this is a bearish pattern. Next, we look at some other patterns. There is this morning star. I will talk about morning star. Then just let me see what all I have to cover. Then I'll talk about evening star. I'll talk about shooting star. So these are the major patterns which I'll be talking about. Morning star is something, what it means is, you can know by the name itself. Morning star means that it is formed in the dawn, that is early morning. So what it means is that the darkness is over, the night is over, and now it is dawn, it is light which is there. So a morning star forms after a major correction. So once a major correction is there, and then you have this morning star formation, then you see that that becomes a strong bottom. So this is a monthly chart of Vedanta. Now, morning star is a bottom reversal signal. So if you find a morning star being formed after a major correction, you can be rest assured that the market has formed a bottom. Then you'll have to, then you can see. And this is forming on monthly charts. That was the low that Vedanta had made, almost 60 or so. From there, the rally all started. So you can definitely look it. So for those of you who are investors, you can look it on a weekly basis, on a monthly basis. Those who are short-term traders, you can look it on a 15 minutes, hourly, or a daily basis, whatever time frame you wish to think of. But you should definitely look at it; it will help you. So a morning star, it's like the planet Mercury. It foretells that brighter things, sunrise is about to occur, or that prices are going to go higher. So if a morning star is being formed after a major correction, it is a sign that a bottom is being formed and prices could rally from here. So it is formed after an obvious downtrend. It is made by a long red body, usually one that is one of the fear-induced days at the bottom of the decline. So you'll find that there's a major correction that has happened, and then it is basically to frighten all people. The next day, the next month, what has happened? Again, made a new low, and then covered back and closed close to the. So this is a doji, and then this was a positive month. So the month started here, that was which was almost the low of the month. Again, made a high and closed towards the high of the day. So this becomes a morning star. So generally, what is a star is that you have a morning star, you have a red candle, red with a large body, and then you have the next candle where the body is slightly is not inside the body of this candle. That is something which you need to hear. It is almost there, but slightly you can see it is not a perfect star, but you can always have variations of it. So here you find that the body is ends here, and this is more or less somewhere around the same level. So you can say that this is a variation of a morning star. So a star, what will happen? See here. This is a better example. You have a downtrend, then you have the next candle, which is, see the body. This body does not engulf or get into the body of this. It is not somewhere here. It is here. And then again you have a next day, which is the up day. Again the body is not inside this. So this is an example of a perfect star, where the body of the second candle does not enter into the body of the first candle or the body into the third candle. But there could be variations that the body of the second candle could be slightly close to the body of the first candle. and the body of the second candle could be slightly into the body of the third candle. But the main criteria is that the body of the second candle should not be inside the body of the first candle. So this is what a morning star is. So what is the logic behind it? That there has been a downtrend, then there has been some consolidation, and then the next day, and there is a gap down. So what it means is that the stock closed here lower, then the next day the stock gap down lower, and then traded in a range or whatever, and then closed higher. So now it means that the bulls are stepping in. The next day, what happens? The third day, that the stock, in this case, the stock gapped up higher, opened higher, and then again made a low, again traded higher and closed at the high. So this becomes a perfect morning star. Definitely, you should start analyzing them, looking at them on the charts. It can really, as I said, it can multifold increase your knowledge and awareness of the markets. So I hope I'm clear on the morning star. So just as we have the morning star, we have the evening star. Here the example taken is a red and blue candle. So here you can see that again this is a major rally which has happened. Then a star is formed. Why is a star? Because the body of the second candle is not in the body of the first candle. But you can see that the third candle, the body is more or less in line with the body of the second candle. So this is still a perfect star, but all this is still a very good star. Perfect would have been that the body is of the third is also away from the body of the second, like this one. But you don't have to wait for the perfect, even if this is being formed, because the market is not perfect. There could be slight variations, but still they work very well. So see what has happened in this particular stock moved up, there was this formation, and the stock corrected from there. So this becomes a top. So you can use it very well, and this is an evening star. So an evening, what does it mean is that an evening star is formed. That means it foretells that darkness is about to set in. This is like the planet Venus. So the darkness is about to set in. So that means that prices are going to go lower. So it means that a top is being formed and there could be a correction. So I hope I am clear. So then I look at this pattern which is called the shooting star formation. So this one, this is a shooting star formation. It is a reverse of a hammer. So you can see a hammer here, but a hammer is formed after a major correction. A shooting star is formed after a major rally. So what is this? Is that shooting star is a type of a candlestick formation that results when a security's price at some point during the day advances well above the opening price but closes lower or slightly at the opening price. So this is a green shooting star. Had it been a red one, it would have been even more better. So what happens in this case? The psychology is the stock opens here, goes as high as here, but then the bulls are not able to hold it back and closes lower towards the open. So the open and the close is very much the same, and which is also the low of the day. Had the close been lower than the open, so this would have been a red candle. But in this case, it is a green candle. Still, it is a shooting star formation. So what you can see what happened, this is a weekly chart of the Nifty. See what has happened. The shooting star is formed. This is also an evening star more or less. And because but this is not red, doesn't matter. You have a red later coming on. So these are all variations which you can see. So this is a shooting star, and then this is an evening star, and then see what has happened. This is the top double top formation. The stock is corrected all the way down. So Japanese candlesticks are, I would say, you should definitely, those of you who are watching this webinar, you should definitely make a serious attempt. If you are serious or you want to be serious to make money in the markets, then you should look at the candle patterns which I've talked about in this webinar. If you can understand them itself, they'll really take you far ahead in your trading or investing. I would say business. So now we'll just talk about that. Uh, the As far as the candlesticks are concerned, once an investment position is implemented, the mental process renders a whole new set of disciplines. So what happens is that candlestick patterns gives you that discipline which is very much required, and no schools teach the proper mental posturing. You can attend seminars to become familiar with disciplined investing, but the real test comes when your own money is on the line. So the Japanese candlestick methodology has built-in advantages when it comes to the mental state of investing. Psychological thought processes are interpreted in the signals development. So you'll find that a shooting star, so what is the logic? You find a hammer, so what is the logic? A bullish engulfing, a bearish engulfing, a white marubuzo, a black marubuzo. So all these patterns, if you can understand them, and you go further deep into these patterns only, and whenever the stock is forming these patterns or the index is forming these patterns, you can take advantage of them. So knowing how the signal is formed creates the advantage. Learning how the market action sets up the signal's credibility provides better insights on how the losing investor thinks. So if you can understand these patterns, and also as I explained the psychology behind some of these patterns, if you understand them even better, you can be rest assured that that will be great help for you. So now we come to the final section of this webinar, that is combining candlestick patterns and Western indicators. So generally, what happens is that if you use Western indicators with candlesticks, that enhances the probability of trades. For example, if there is a bearish candlestick formation in an overbought zone, so the stock is in an overbought zone, that is, if you're looking at RSI or stochastics, it is above 70 or above 80, and a bearish candlestick pattern is being formed, then that means it's a chance, your chance of success improves significantly. Similarly, if there is a bullish candlestick pattern formation in an oversold zone. So the stock is in an oversold zone, that is below 30 or below 20, be it RSI or stochastic, and where you find a bullish engulfing pattern or a morning star doji form or a hammer being formed or a couple of candle patterns forming together, the probability increases of the trade going in the right direction. Also, you should look at the overall trend before placing a trade. As it is well said, the trend is your friend. So you can use a 10 period EMA. That's quite useful in determining the short term trend. So Japanese candlestick patterns can be used very well for that. We'll just take a couple of this example here, is that if you look at this particular chart, what we are seeing here is that the stock has this is a daily chart, as you can see. So what we are finding here, this is a morning star. We have a major correction. We have this body which is not in this body, and again we have this which is not inside this body, and this also becomes a hammer. So this becomes a morning star plus a hammer, and this again is an inverted hammer. So this inverted hammer won't make much sense, but had this been formed at somewhere at the top, it would have made more sense. So you have a morning star formation here, and the market is in oversold territory. So you can see that it is below 20. I'm using stochastic 14 period here. So you find that this is below 20. So this can be a good buying opportunity. So the stock from 34.40, it rallied all the way to 38.40. So it was a 400-point rally, and where your stop loss is, the stop loss is below the low. So this is an end of day which you can do. So if you are very busy, don't have time, then you can look at this. If you have the time, then you can look at even 15 minutes hourly or daily charts intraday. You can. So I hope this is clear. I'll just take another example. Here what we are seeing is that in this particular stock, we see that this is in overbought territory. So the stochastic reading is above 80. And here again what we are seeing is a doji formation. Here what we are seeing is more or less an evening star formation. Here what we are seeing is a tweezer's top. That is, a tweezer's top is just like your pair of scissors. So the height of this candle and the height of this candle is the same. This is a daily chart. So now this becomes a top. Where is this being formed? In overbought territory. See what has happened from there. From almost 1380, the stock came down all the way down to 1130. So a 20% decline in the stock. So this is what I'm saying. You don't have to go by it. If you can yourself look at the charts, you'll find that you'll find many such instances which are happening. So if you can work on these patterns along with some Western indicators which I've talked about, you can really excel and gain significantly. So so overall, if we look at this, so in trading, to succeed in trading, you need both confidence and caution. Having only one is dangerous. So this using candlestick patterns will give you the confidence, and also it will help you to be cautious when you are required to be cautious. Because if you are over confident, then one might become arrogant, and if one is very cautious, then one might not be able to take the trade. So Japanese candlesticks can really help you significantly enhance your trading skills and can make you a very good trader as well as an investor if you're looking at the weekly and the monthly charts. And it can be a game changer for you. So with this, we conclude the webinar. We have this Angel's advanced charting application in Speed Pro, which is there. So if you are not using it, you can use this if you're a user of Speed Pro, which gives you the charting tools and everything that's available. And for that, you have to write to ebroking@angelbroking.com, mentioning your client code with a request for activation of Angel Advanced Chart. So with this, we end the this webinar. Thank you so much.